the bright side of the dreamy middle class is always luxury and comfort. But is it always so wonderful? Today, let's take a look at the money traps that can lie in wait for you and your family. Every class has its own plans and dreams, but often these are accompanied by high costs. Credit card purchases, frenzied consumer loans, and loaded mortgages can turn into money traps that can be difficult to deal with. Money traps in everyday life. High credit card interest rates are the high interest rates that banks or credit institutions charge users for the borrowed funds they use on their credit cards. These rates are expressed as a percentage per annum and are determined based on a variety of factors, including the user's credit score and the bank's judgment. Typically, higher credit card interest rates are applied to those debts that remain on the card after the end of each month, after the minimum monthly payments have been made. This means that if you don't pay your debt in full, interest will be charged on the unpaid amount. High interest rates on credit cards can significantly increase the total amount you have to pay back and make using credit expensive. This can lead to increased consumer debt and financial difficulties if you do not pay your debt on time and in full. 2. Minimum monthly payments on credit cards are the smallest amount of money you need to pay each month to meet the terms of your credit agreement and avoid payment fees or penalties. This amount is set by the bank or credit institution and is usually expressed as a percentage of the total amount owed on the card. The minimum monthly payment consists of two main parts: principal repayment. This is the portion of the payment that goes toward reducing the principal amount of your debt purchases made with your credit card. It helps you pay off some of your debt. Interest. This is the part of the payment that goes to pay the interest on your credit. Interest is charged on the balance of the debt and is the main source of income for the bank or credit institution. It is important to understand that paying only the minimum monthly payment may result in the debt not being paid in full within a short time. Interest will be charged on the rest of the debt, which may increase the total amount you have to pay. 3. High housing costs. This is a situation where a significant portion of your income is spent on housing costs, such as rent or mortgage, as well as utilities such as electricity, water, heating, and other housing-related expenses. This can be a financial trap, as high housing costs can limit your ability to save money or spend it on other important needs. Typically, high housing costs arise from the following reasons. High housing costs. Rent or mortgages can be very expensive in some regions, especially in cities with high demand for real estate. Utilities. Paying for utilities such as electricity, water, gas, and others can also have a significant impact on housing costs. Housing maintenance. Housing maintenance and repairs, such as repairs, home insurance, air conditioning, and heating maintenance, can increase housing costs. High housing costs can make it difficult to save money, invest, and meet financial goals. 4. Excessive spending on food and entertainment. This is a situation where you spend too much money on food, restaurants, cafes, movies, travel, entertainment, and other entertainment expenses that exceed your financial ability or budget. This problem can have several consequences. Financial stress. Excessive spending on food and entertainment can lead to financial instability, debt accumulation, and financial stress. Inefficient use of resources. Money spent on excessive entertainment may be spent inefficiently and not be used for more important financial goals, such as saving for the future or paying off debt. Limiting financial growth. Spending too much on food and entertainment can limit your ability to save and invest, making it harder to achieve financial stability and independence. 5. Lack of financial literacy is a lack of knowledge and understanding of financial matters that can affect your ability to manage money effectively, make sound financial decisions, and achieve financial stability. This may include not knowing basic financial concepts, not understanding basic terms and concepts such as budget, interest rate. Inflation can make managing your finances difficult. Inability to budget. Lack of skills in budgeting and spending planning can lead to inefficient use of money. Mauling, credit indiscipline, improper use of credit, lack of awareness of interest rates, and failure to pay debts on time can lead to debt problems. Lack of investment skills, ignorance, and distrust of investments can lead to missed opportunities for capital growth. Ineffective risk management, lack of knowledge about insurance, and the ability to assess financial risk can lead to financial difficulties in unexpected situations. 6. Medical expenses are the costs associated with obtaining medical care and ensuring your physical health and well-being. They include a variety of different types of health care costs, such as doctor visits, expenses for doctor's consultations, both general and specialized, as well as preventive examinations, medicines and medical supplies, expenses for prescription and over-the-counter medications, vitamins and supplements, medical tests, expenses for laboratory tests, X-rays, MRIs, CT scans, and other diagnostic tests, hospitalization and treatment expenses for hospital and inpatient care, health insurance, payments for health insurance coverage, which may include premiums and fees, hygiene products and medical devices, expenditures for personal care products, first aid kits and medical devices, i.e. glasses, hearing aids, physiotherapy and rehabilitation expenses for physiotherapy and rehabilitation following injury or surgery. 7. Education debts are loans or borrowings that have been taken out to finance educational expenses, such as university, college, or other educational institutions. These debts include payments for tuition, books, courses, and other related expenses. Education debts can be government provided by government education loan programs, or private obtained from commercial banks or other private lendor. Repayment may begin after graduation or after a period of declared postgraduate practice. Car loans and car maintenance are the costs and financial obligations associated with the purchase and maintenance of a car. This may include the following aspects. Car loan. This is a loan you take out to buy a car. You must pay the loan plus interest over a specified period. Car loan payments. Monthly payments that include a portion of the principal and interest. These payments can last for several years. Fuel. The cost of fuel for the car. It can vary depending on the type of car and your travels. Maintenance and repairs. Regular maintenance, parts replacement, and repairs to your car. Car insurance. Payments for insurance against irreversible loss, vandalism insurance, accident insurance, and other types of insurance for the car. And tolling. Expenses for parking and tolls, such as customs or road tolls. Attended indebtedness. In this context, it means a high level of debts or financial obligations that exceeds the ability of a person or organization to pay them. A situation of high indebtedness can arise for a variety of reasons, including excessive use of credit cards, excessive borrowing, high medical expenses, or inability to pay loans and bills on time. 10. Incomplete retirement preparation indicates that a person has not adequately prepared or completed their retirement planning. This can mean several different things. No retirement savings. This refers to the absence or very limited retirement savings, such as pension funds or other investment accounts, intended to provide financial security in retirement. Ambiguity about retirement benefits. This may include a lack of understanding of what retirement benefits are available, what requirements need to be met to receive them, and when to start planning for retirement. Unclear financial goals after retirement. Incomplete retirement preparation can mean not having a clear plan for how expenses will be covered after retirement. Lack of understanding of investments and risks. This may include a lack of clarity about investment opportunities and risks associated with retirement savings. Incomplete retirement preparation can lead to financial insecurity and insufficient provision in retirement. But it's not all bad. There are ways to avoid these pitfalls. Financial literacy is the key to success. Planning a budget, saving money, and using credit wisely can help you maintain financial stability. Tips for financial literacy. Plan for weekly, monthly, and annual expenses. Learn to live on less than you earn. Reduce consumer loans. Try to avoid them and replace them with savings for purchases. Use credit cards wisely. Set limits on your credit card and stick to them. Keep learning about financial literacy. Read books, listen to podcasts, and take financial courses. Consider investment opportunities such as stocks, bonds, real estate, and retirement accounts. Investments can help you build wealth and provide retirement income. Periodically review your expenses and determine which ones you can reduce. You may want to give up some entertainment in favor of savings. It is important to discuss financial goals and plans with your family. Understanding and support from family members can help you achieve financial success. If you already have debts, stick to your repayment plan and try to reduce them. Avoid new debts if possible. To wrap up, let's remember the importance of being financially literate and avoiding money traps that can become an obstacle to your financial well-being. Choose wisely and be the master of your finances. Your future depends on your decision today. We hope this video has inspired you and helped you understand how to avoid money traps. Please share your thoughts and experiences in the comments below. Together we can achieve financial success.